Let's cut to the chase. Every beginner investor makes mistakes, but some stick with you regrets that linger for years, eating into returns and derailing your financial goals. These aren't small oversights. They're costly errors that even seasoned investors once made, and they're entirely avoidable if you know what to look for. Today, we're breaking down the 5 mistakes beginners always regret. No fluff, just straight talk on why they happen and exactly how to steer clear of them. First mistake, investing without knowing your risk tolerance. This is the biggest, most common regret I hear. New investors jump in with both feet, buying stocks or high-risk funds because someone said they're good investments, without stopping to ask if they can handle the downturns. Here's the truth, risk tolerance isn't about how much you want to earn, it's about how much you can lose without panicking, without selling at the worst possible time, without derailing your daily life. You can't invest like a 25-year-old with no bills if you're 55 and approaching retirement. You can't put your rent money or emergency savings into the market and expect to sleep at night. Many beginners skip this step, and it costs them. They see a 10% drop in their portfolio and sell immediately, locking in losses they never had to take. They borrow money to invest, thinking they'll pay it back with gains, only to end up with debt and a smaller bank account. How to avoid it? Start by taking stock of your financial situation. List your monthly expenses, your emergency fund, you need one, don't skip this, and how much you can afford to lose without changing your lifestyle. If a market drop would make you check your portfolio 10 times a day or stress about paying bills, that investment is too risky. Younger investors can afford to take more risk, focus on index funds or diversified portfolios. If you're closer to retirement, stick to more stable options like bond funds or money market accounts. And never, ever invest money you can't afford to lose. It's that simple. Second mistake, investing in what you don't understand. I've met beginners who put thousands into crypto, penny stocks, or niche funds just because a friend or social media influencer said it's the next big thing. They have no idea how the investment works, what drives its value, or when to sell, and they regret it when it crashes. Warren Buffett once said he never invests in a business he can't explain to a child. There's wisdom in that. If you can't tell someone exactly how your investment makes money, whether it's a stock, a fund, or a real estate deal, you shouldn't be putting money into it. Beginners get caught up in the hype, chasing quick gains without doing the work. They see terms like P/E ratio, net asset value, or dividend yield and tune out, thinking they don't need to know. But those terms are the basics. They tell you if an investment is overvalued, stable, or worth your time. How to avoid it? Do your homework. Spend an hour learning the basics of any investment before you put money into it. If you're looking at a stock, research the company's revenue, profits, and competition. If it's a fund, check what it invests in and how it's performed over time, not just the past few months. Skip the get-rich-quick schemes. They're almost always scams or unsustainable. Invest in things you use, understand, and believe in. If you use a certain product every day, that company might be a good investment. If you don't understand crypto, don't invest in it. It's better to miss out on a trend than to lose your hard-earned money. Third mistake, trying to time the market. This is a regret that haunts even experienced investors. But beginners fall for it hard. They wait for the perfect time to buy, waiting for the market to hit a low and then wait too long, missing out on gains. Or they sell as soon as the market dips, thinking it will keep crashing, only to watch it rebound without them. The truth is, no one can time the market consistently, not even the so-called experts. Beginners think they can predict when stocks will go up or down, so they hold on to cash waiting for the right moment, or they sell at the first sign of trouble. Over time, this strategy costs them dearly. The market rises more often than it falls, and missing just a few of the best days can erase years of gains. I've heard countless stories of beginners who sold during a small downturn, only to see the market recover and grow 20% in the next year, regretting every dollar they missed out on. How to avoid it? Stop trying to time the market. Use dollar cost averaging instead. That means investing a fixed amount of money at regular intervals every week, every month, regardless of market conditions. When the market is low, your money buys more shares. When it's high, you buy fewer. Over time, this evens out the ups and downs, reducing your risk and removing the emotion from investing. It's not glamorous, but it's effective. And once you invest, hold on, don't sell because of short-term fluctuations. Focus on the long game. Investing is a marathon, not a sprint. Fourth mistake, ignoring fees and hidden costs. Fees might seem small one here, 0.5% there, but they add up over time, eating into your returns without you even noticing. Beginners often overlook fees when choosing investments, focusing only on potential gains. They pick a fund with a high expense ratio, or they trade frequently, paying commission fees every time they buy or sell. By the time they realize how much they're paying, they've lost thousands in potential returns. Hidden costs are even worse. Some platforms charge account maintenance fees, transaction fees, or redemption fees if you sell too soon. Others have hidden charges in the fine print that you don't notice until it's too late. Beginners think they're making money, but after fees, their returns are much lower than they expected, and that's a regret that's hard to shake. How to avoid it? Read the fine print. Always check the expense ratio of any fund you're considering. Lower is better. Look for no commission trading platforms to avoid paying fees every time you buy or sell. Avoid frequent trading. Every trade costs money, and it's almost impossible to make up for those fees with quick gains. If a platform has hidden fees, walk away. There are plenty of low-cost options available. Remember, every dollar you pay in fees is a dollar that could be growing in your portfolio over time. Fifth mistake, letting emotions drive decisions. Fear and greed are the biggest enemies of successful investing, and beginners fall prey to them every time. When the market is rising, they get greedy, buying more than they can afford, chasing hot stocks, and ignoring the risks. When the market is falling, they get scared, selling everything, panicking, and locking in losses. Emotions cloud judgment, and they lead to decisions you'll regret for years. I've seen beginners buy a stock because it's trending, only to sell it a week later when it dips, losing money. I've seen others hold on to a losing investment because they're too proud to admit they made a mistake, watching it drop further and further. Emotions turn rational investors into impulsive gamblers, and that's a quick way to lose your savings. How to avoid it? Create a plan and stick to it. Decide ahead of time what you'll invest in, how much you'll invest, and when you'll sell. If a stock drops below a certain price, sell it. Don't let fear make you hold on. If a stock rises above your target, sell some of it. Don't let greed make you risk it all. And don't check your portfolio every day. The more you check, the more emotional you'll get. Set a schedule. Check once a month, once a quarter, and stick to it. Investing should be boring. If it's exciting, you're probably making a mistake. Let's recap. The 5 mistakes beginners always regret are: investing without knowing your risk tolerance, investing in what you don't understand, trying to time the market, ignoring fees and hidden costs, and letting emotions drive decisions. All of these are avoidable. You don't need to be a genius to invest successfully. You just need to be patient, do your homework, and keep your emotions in check. Now, I want to hear from you. Which of these mistakes have you made? Or which one were you about to make before watching this video? Drop a comment below and let me know. And if you found this helpful, hit the subscribe button, because I'm sharing more no-nonsense investing tips to help you avoid regrets and build long-term wealth. Don't miss out. Subscribe now, and let's grow your portfolio together.